Hey everybody, my name is Rod Rohde, and I am the product manager here at Man Mortgage. And I'm going to take you through a little training today I call Mortgages 101. With this, I like to give a background on what mortgages are, where they came from, and where the money comes from. Give you a hint, it's not banks. So let's get started with Mortgages 101. Let's talk about the players. So who are these people that Rod is talking about? So we're going to talk about the agencies. So the agencies are conventional loans. They're the conventional. They're the conforming. These are the ones that you typically see advertised the most on billboards and things like that because they are done through these entities that provide a lot of liquidity in the marketplace. They have the size, they have the ability, and they are actually owned by the federal government. So you may have heard of Fannie Mae before. It actually stands for the Federal National Mortgage Association, otherwise known as Fannie Mae, otherwise known on the stock market previously as FNMA. It was created in 1938 during the Great Depression as part of the New Deal. It was publicly traded since 1968 up until 2008. Its counterparty is the Federal National Mortgage Corporation, otherwise known as Freddie Mac, aka FHLMC. That was started in 1970 to basically do the same thing as Fannie Mae, that way that there's an extra player in the market. Fannie Mae gets a little wacky, Freddie Mac can step in. They made a lot of money. So Freddie Mac does basically the same thing. They were also publicly traded until 2008. In 2008, as part of the Great Recession, you heard a lot of stuff, you saw a lot of articles about where they got a bailout. So we talked about on the previous slide that last year, Fannie Mae made $12.9 billion. Freddie Mac made $9.3 billion. And I think we all know that last year was not the best year for mortgages, but they still made a lot of money. See, all that money actually gets swept to the government. So I've heard people say, never validated it, that actually the conservatorship or the investments in Fannie Mae and Freddie Mac, because of the money they've swept back from the companies since they've done it, was actually the best investment in the history of Wall Street. So there is that. We also have another player. These are Govy loans. So this is the Government National Mortgage Association, otherwise known as Ginnie Mae. This is a wholly owned government corporation within the Department of Housing and Urban Development. So they securitize, just like we talked about in the last example, they securitize loans for FHA, VA, and USDA loans. So they're the people that determine all the rules and do the underwriting for FHA, VA, and USDA loans. In this example, Fannie Mae and Freddie Mac would be replaced by Ginnie Mae. But why do we do this? The purpose of all of this is to put a bunch of mortgages in a big box, assign a price to them, and sell them, because money. So the purpose of all this is to take a whole bunch of mortgages, put it into a big box, assign a price to them, and sell them, therefore making a profit and getting new capital to lend. In order to do this, we have to know what's in the box so they can be priced correctly. The oldest and most basic rule on Wall Street, heck, human endeavor, is weighing risk versus return. Everything is all about risk versus return. How do we get the most stuff for the minimum amount of risk? Isn't that what we all want? Originally, back in the day, cavemen had to weigh going after a saber-toothed tiger versus a deer for food. Now, tiger might taste awesome, and they're huge. You can feed the whole village for like a week off of one giant 800-pound tiger. The deer's a lot less likely to get you dead. So it's weighing risk versus return. Today, you have the option where you can go and invest all of your money in the startup in your neighbor's garage, or you can go buy one share of Berkshire Hathaway, Warren Buffett. If your neighbor becomes Microsoft, you're suddenly really smart. If it flops in 6 months, not so much. It's all about assigning risk and probabilities to the loans, then pricing for it. For example, a primary residence is less risky of foreclosure than an investment property, because if money gets tight, you're going to pay on the home you live in a lot faster than you will on one that maybe you have a renter in, or maybe there is no renter in it, or it's your vacation home. You like your vacation home, but you need some place to live every day, so you're more likely to pay that primary residence versus the second home or the investment property. 15 years are less risky than 30 years. Purchases are less risky than a cash-out refinance. Higher credit scores are less risky than lower credit scores. So these are all things that have basis in logic, but have also been statistically shown over 10, 30, 50 years. Stats, lots and lots of stats. Which brings us to the 4 C's of credit. So this is how all of us old school mortgage people learned about mortgages. Is you have the 4 C's of credit, those being credit, collateral, capacity, and cash. So this is how all mortgages have been graded and scored forever. Credit. That's your credit score. It's your FICO score. So the theory behind this is the best predictor of future behavior is how you've behaved in the past. So do you pay your bills in the past? You're probably likely to pay them in the future. So if you have responsibility, you're probably going to keep having responsibility. It's more likely than not. It's not a perfect predictor, but it's the best we can do. And statistically, it's proven out over time. So collateral is how much money are you putting down? Are you putting 20% down? Are you putting 30% down? Or are you putting 3% down? How much money are you putting down? If we end up taking this house back from you, how much money am I going to lose? Because if you put 30% down and we take this back, we can probably sell it, recoup our money, and not take a hit. If you were only putting 3% down and there isn't any appreciation and we end up foreclosing, we're probably going to eat a whole bunch of money on. Works similarly on refinances. We call it loan to value. So loan to value, what is the loan as a percentage of the value of the home? So number one, you have skin in the game. You actually came out of your own pocket in order to put money down on this home, so you're probably going to take it pretty seriously. Number two, you have equity. So if you have equity in the property and times get tough, money gets tight, you can probably sell it and get out of it and pay us off our money. And three, if none of those things happen, then ultimately we'll take the house back, we'll sell it, and be able to get our money back. Next up is capacity. Can you afford it? This is your debt to income ratio. So what we're going to look at is what is your total monthly debt obligations as a percentage of your total predictable recurring monthly income, debt to income ratio. So it's, can you afford it? So if you're completely maxed out and all of your payments are all the way up there, it can be a problem. So it's looking at your debt to income ratio. And then last up is cash. How much money do you have after this thing is done? So you put your down payment down. Do you have any money left in the bank? Do you have any reserves? If things get tough, do you have money in the bank? If you blow out a tire, are you now going to default on your house payments? So it's looking at how much cash you have remaining after the loan is done. So let's look at those, how they relate to all of our loan programs. So we're starting looking at those conventional versus our govy loan. On a credit basis, so the first C of credit is basically conforming conventional loans with Fannie Mae and Freddie Mac. They go down to like a 620 credit score. You are allowed to have bankruptcies, but you do have minimum waiting times, 2 to 4 years, depending on what type of bankruptcy on a conventional, 7 years on a foreclosure, 2 years on a short sale. And then on government loans, you have a much lower credit score requirement and lower bankruptcy, foreclosure, short sale waiting period. So it allows you to be able to get back into those loans, be able to buy a house sooner. However, the government loans typically, except the VA, have maximum limits. So you can't typically go as high on loan amounts with those government loans, particularly FHA, as you can with the conventional one. Now we'll look at collateral. So down payment. So Fannie Mae and Freddie Mac will actually allow you to do it with 3% down. You can do a rate term refinance, which is where you're only changing the rate or the term. You're not getting any cash out. You can do that up to 97% of the home's current value. And on a cash out refi, you can go up to 80%. Now on an FHA loan, you can go to 96.5% of the purchase price, 97% of the current value, or a cash out refinance to 80%. VA loans, I'll let you go all the way up to 100% because we appreciate our service member. USDA is the less often used because within this Ginnie Mae government portfolio, it is only used on homes that are rural of nature, so they have to be on a specific rural map, but you can actually lend up to 100% of the home's value. You cannot go to 800%, sorry, that's a typo, 80% on a rate term, and you cannot do a cash out refinance. But like we said, is the maximum loan limits on the Fannie Mae and Freddie Mac loans is up to $726,000 in most places, but in high cost areas, you can go up to $1.396 million. Then they do also have a high balance program. Okay, like we said, these Fannie Mae and Freddie Mac loans do allow to go up to higher loan limits. So depending on where you live, it's based off of normal selling trends in that market. And it also depends on if you're buying a 1, 2, 3, or 4 unit property. So if you're buying a 1 unit property, the standard lending limit is $726,200. Now you can go all the way up to $1.396 million on 4 unit properties, or they do also have a high balance program where in specific areas they're deemed to be high cost. They'll let you go above that $726,200 limit. Now the FHA loan limits are quite a bit smaller. VA does not have a lending limit, but most lenders will have particular overlays. Like I think we go up to $2 million here at Man Mortgage on a standard basis. Anything over that's kind of on an exception. So the next C we're looking at is capacity. This is that debt to income ratio. It's can you afford this house? Are you going to have enough money to make your payment every month? So kind of the standard guideline on that is they look at two ratios. One's called the front ratio, one is the back ratio. Front ratio is just what is the mortgage payment divided by your total monthly recurring expected income. Then you have your total debt ratio, which is all of your debts. So it's your house, your car, your student loans, your credit cards, anything else that's on your credit report. What is your total debt obligation divided by your total monthly predictable recurring income? So they're going to look at both of those. So the standard guides are 28% for the front ratio. So basically your house payment cannot exceed 28% of your monthly income. And the back ratio is 36. Now on the FHA loans, they do go a little bit higher. So they'll allow for a ratio of 31 and a back ratio of 43. You do have 41% on VA and 41% on USDA. Now, these are the standard guidelines. Now, you can go higher than that. You can go 40, 50% on those Govy loans with compensating factor. And then there is another wild card within these that I'll talk about in a minute. But these are the standard rules. These are the general things you look at if you're being better safe than sorry. And then cash. So how much cash do you have after the fact? So we're going to talk about that. It's reserves. So after typically Fannie Mae and Freddie Mac want to see that you have 2 months worth of mortgage payments still left in the bank after you buy the house. So that way you don't make an extra trip to Target. Now you can't afford your mortgage payment because you bought extra back math. Ginnie Mae is a little more lenient because that's just how they are. Now they only require 1 month worth of housing payment. And then there's the issue of mortgage insurance. So this is where it gets a little more complicated over time. Back in the old days of mortgages, people had to put 20% down in order to get a mortgage. That way the banks were super safe. So a long time ago, mortgage insurance was invented. This is where these giant insurance companies came in. Now they're real good at assessing that risk versus return, the weighing the risk versus the return on the money. They're the people with all the big statistics and the big pocketbooks. And they said, hey, we're really good at deciding when to go after the tiger, when to go after the deer, and let's make a deal with you banks and Fannie Mae and Freddie Mac. Okay, you know us. We got a ton of money. So if you let Rod come and buy a house for less than 20% down, we will insure you so that if he does foreclose and you have to take the house back, we'll give you a bunch of money so that way you're safe and you don't lose any money. So the bank said, okay, that seems like a pretty good deal. So then the mortgage insurance company came in and said, hey, Rod, I got a deal for you. I talked the bank into letting you do this mortgage with a lot less money down than that 20%. Hey, thanks, guy. That's awesome. But hold up. I didn't say I was doing it for free. Not that nice of a guy. So you're going to have to pay me a little bit of money every month to compensate me for the risk I'm taking on all these things. So that's where mortgage insurance comes into play. So that's the private mortgage insurance that comes on these conventional loans, because it's an outside company ensuring that Rod isn't going to default to the bank, so the bank is okay with wider lending guidelines. It's kind of the equivalent to what Ginnie Mae has done forever. They have their own version of it. So on an FHA loan, the borrowers will pay a 1.75% upfront fee to the Fannie Mae, to Ginnie Mae, and that is financed into the loan. So all these FHA loans forever have been about 1.75% is financed into the loan upfront that goes to Ginnie Mae for insuring these loans and compensating the lenders if there are defaults, if they lose money on these things. Then also on those FHA loans, they have to pay 0.5% per year, per month as part of mortgage insurance. That's on the FHA loans. The VA loans do not have a monthly component, but they do have an upfront premium. That ranges anywhere from 1.5% to 3.3%, depending on how often they've used it and how much entitlement they have. Though the most common is 2.15%, which is for first use with zero down. But they do not have the monthly component. And then USDA loans are kind of somewhere in between, where it's 1% upfront and 0.35 per month. That all comes into play. So then we have the wild cards. So these are the government entities, but there are banks. I didn't say none of the money comes from banks. So there are a lot of other people out there, including banks, hedge firms, REITs, investment companies, wealthy individuals, private funds that say, hey, that's cool, Fannie Mae, Ginnie Mae, Freddie Mac, you do all that stuff, that's nice. That's pretty cool. But we got money too, and we want to play in this game. So that's where non-conforming or non-agency loans come into play. These can a lot of times go by different numbers. It can be jumbo loans. So if somebody's looking to do a $4 million home, the government isn't going to play in that game. So they have to go to these private individuals, hedge funds, private banks, investment companies, wealthy individuals, and they'll do those. So it can be jumbo loans. It can be Alt-A loans. It can be non-QM loans. Back in the day, they called them subprime, but we don't do that. Whoa. No, we don't do that no more. We do non-QM, which actually is a lot safer. I'm mocking it, but it is a lot safer. So these people, they can make up their own rules because it's their money. So they might say, we don't care what your credit score is. We'll still lend to you. We have lenders that'll do that. They don't care about the actual credit score. They're gonna look at the credit profile and say, do they pay their bills on time? Okay, maybe their credit score is low because their credit cards are maxed out, but they're always paying them, so we'll lend to them. We have places that will do 1 day out of bankruptcy. Your bankruptcy was discharged yesterday, you get a loan today. Foreclosure yesterday, you get a loan today. Short sale yesterday, you get a loan today. We have all this stuff. Loan amounts, maximum loan amount, how big you want to go. We got people who go $30, $40 million. Can you afford it? Can your capacity, can your debt to income ratio support it? Can your other things support it? We'll get you the money. Capacity, debt to income ratio. We got a whole bunch of lenders that go 50%, 55%. There are even some lenders that say, we won't pay attention to what your income is. We don't need to see your income as long as these other factors come into play, in which case we will bank it. We'll take the loan and you get your house. You can use bank statements for income instead of using tax returns. You can look at, we'll just get a whole bunch of bank statements and use that to show income. 1099s, none at all. There are a bunch of options in this wild card field. Cash, depends. Buying a bigger loan, you might need a little more cash. Smaller loan, not as much. Don't have as much, okay. Put a little more down, you don't have any reserves, we can still do it. Put less down, more reserves, still do it. Don't have any reserves, maybe, probably, we'll do it. So it's all about risk and return. They have their own rules, they have their own thoughts, and they have their own money. So it's my money, and I'll do what I want with it, America. So it all depends. And then mortgage insurance, might have mortgage insurance, might not. It's their rules. They'll do whatever they want. So this is kind of the overall lending environment. And the big thing that came in that we talked about was DU and LP. About 20 years ago, stroke my long imaginary beard here. About 25 years ago, two little computer systems known as Desktop Underwriter and Loan Prospector came into the marketplace. So this is when Fannie Mae and Freddie Mac started these computer software systems that allow the lenders to actually upload their file into the system and it'll automatically generate an approval. So we have all these rules up here on the page of the debt ratios, the amount down, the reserves, and everything like that. These are kind of the general guidelines at this point because ultimately the computer is going to decide it. So we're going to take that file, we're going to upload it into the computer. The computer's going to run through and say, okay, well, the debt ratio is a little bit higher, but the cash is a little bit higher as well. So that's pretty safe. And they're putting more than the 3% down. They're putting 15% down. So the total risk, okay, one thing's a little bit higher than we want it to be, but two other things are lower than we want them to be. Okay, we'll do that loan. So ultimately on these Fannie Mae, Freddie Mac, FHA, VA, and USDA deals anymore, it's all determined by that computer. And we all use the same computer. So whether you come to Man Mortgage, you go to a mortgage broker, you go to Rocket Mortgage or Chase Bank, we're all going to run it through the same DULP and get the same approval. So ultimately it's up to them, to the magic box in the sky to determine who gets these mortgages. But why do we do it? So this is what we get down to. So why do we do it? So that's where, we talked about on a previous slide. Let's go back. It is all about the most basic rule of all human endeavor, weighing risk and return. And we all got different opinions on that. We had the Fannie Mae, we had Ginnie Mae. We talked about their rules, and then we have the private individuals. And the private individuals come in, they say, I got my own rules. I will lend to people that Fannie Mae and Freddie Mac won't, but I'm not doing it for free. So it's all about pricing. So right here on the screen that you see is an example. It is the as of today, which is October 2nd, 2023. These are what's called the loan level pricing adjusters for Fannie Mae. So this is their base price that has to go into every loan that meets these particular criteria. So for example, if the borrower has a credit score between 720 and 739, and they are putting 20% down or 80% LTV, then Fannie Mae is going to charge 1.25% of the loan amount as a fee. So that has to be either factored into the pricing or paid by the seller or paid for by the borrower. But it is mandatory. It's how Fannie Mae prices these mortgages because they need everything in the box to be priced fairly. So that box might contain somebody with a 630 credit score and it might contain somebody with a 780 credit score. So they have different price adjusters because we need to be compensated for the risk. We'll take on extra risk if there's extra reward. We're not going to go after that 200-pound saber-toothed tiger when we could get a 200-pound deer that won't kill us. So it's all about the risk and return. So they have these pricing adjusters in there. So at different loan to value, so 5% down, between 5 and 10% down, between 10 and 15% down. And at each FICO band, there is a different pricing adjuster that's associated with this. This is mandatory. Again, this is standard whether you go to a mortgage broker, banker, bank, hedge firm. Anybody selling these loans to Fannie Mae is going to have this same minimum grid. Now, some investors will add things on top of this because they're like, I'm going to hold the loan. My rules, I'm going to make a little bit of extra money on some of these borrowers I think have higher risk ratings. Or they could even take it down because maybe they look at their portfolio and they say, I have way too many people with low credit scores. I need people with higher credit scores. So they'll actually eat some of this. Then you have other adjustments. So there are price adjustments for adjustable rate mortgages with higher loan to values. Condos have price hits. Investment properties, second homes, manufactured homes, 2 to 4 unit, high balance fixed rates, subordinate financing. So if there is a mortgage behind this mortgage, it's seen as riskier or it's been statistically proven to be riskier, more likely to default. So you have to have these pricing adjusters in there to compensate for the risk. And like I said, that's across the board for anybody selling to that. But why? We have to talk about why do we do that. We have the 4 C's that tell us we can do the loan. Now we have to price for risk. There should be a higher return for riskier loans. Riskier loans should pay more. As we saw earlier, the base pricing is set by the market. So the Fannie Mae sells the $100,000 loan at 7.5% to Freddie Mac. They get their $1,900. Freddie Mac sells a bunch of them at 7.5% into a 6.5% bond. The servicing fee is 1% per year, which is 7.5 minus 6.5. And they estimate the loan be around for 3 years. So 99.49, which is kind of what they might be able to sell for because Fannie Mae needs to make some money. And add the 3 points, it's 102.49. And Fannie Mae sells that 6.5 mortgage-backed security on the market at 100.05. So that's how it works. And then you just have to use the pricing adjusters to price in the price. So the 4 C's determine we will do the loan. The adjusters adjust the price for the right price of it. And so once we determine that the loan can be done and it's priced right, so we take the application, verify the information, underwrite the loan, close it, fund it, and sell it. So that gets us the money to keep the lights on, feed Rod, and lend again to the next client. Then we do it over and 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 over. So welcome to the mortgage business.